In this video, I'm going to talk about the 8 reasons that Paul Tudor Jones is one of the greatest traders of all time. Stay tuned. Hey traders, a very warm welcome to you. Okay, so if you checked out any of my previous videos on this channel, it's a good time to subscribe if you haven't already. And if you are a subscriber, hey, welcome back. You know I talk about traders like Paul Tudor Jones, Jesse Livermore, all those kind of great traders, and a lot of kind of newer traders as well. We talk about some of the fund managers and kind of learning lessons from each. And Paul Tudor Jones, in my eyes, is one of the best traders out there, and he's got the kind of returns to prove it. His fund has been doing well. Yes, he doesn't always make money, and he has times he has to draw down on his fund a little bit, but generally speaking, you know, he's had a great career and he's done some great stuff out there. So here are the really 8 reasons. There are more, but I think these are the top 8 why this guy has done so well. And listen, these are going to be revolutionary, and trading isn't revolutionary, guys. It's keeping things simple, but being a master of the small details and being a master of the simple things is what makes the difference. Right, I'm going to bring my laptop in here because I want to quote some of the things that he said. Let me just reduce the brightness so I'm not completely looking like a ghost in front of you guys. Okay, so the first one is price action focused. You know, he never really went into town or to town with the fundamentals. He was very much based on price action. You know, one of the comments he said, and this is the quote that I want to use, is at the end of the day, your job is to buy what goes up and sell what goes down, right? So he's not trying to be clever about things. He's looking to, you know, get on the end of moves. And actually another quote he made, which I haven't got here, was, you know, he made a lot of money kind of fading extreme trends as well. So not only was he very good at recognizing price action turning points, he was also very good at saying to himself, you know what, the fundamentals don't matter so much. Now, I don't know whether he took fundamentals into account. I'm sure he did, but ultimately the point is his decision-making process was based on price action. He was literally looking at what is happening with price. Is it agreeing with maybe my analysis, if I can say the word, with my analysts or my analysis, whichever you want to look at. Does it agree with it? Does the price action agree with what my analysts are saying about the stock, or what I think about the stock, or the company, or you know, the futures market, whatever it may be, and then making the trade? And you can see the difference between this approach and perhaps some other fund managers or traders that we see in the headlines today who are taking big losses based on the thought that they are right. You know, they're doing big studies, they're doing big fundamentals, and the fundamentals look great. You know, you think, yeah, you know what, that looks very sound. But then they've got a big position on, it's going against them because the market doesn't agree. And at the end of the day, it's price action that matters. Very well having a thesis, very well analyzing something and having a suggestion of what you think could happen, but then combine it with price action. I think that's where the biggest power is. All right, let's move on from that, guys. Number 2, flexible and his lack of ego. So, you know, this is a big one. Admitting you're wrong and being able to exit the trade. Even if, again, going back to the thing, your analysis says that you should be right, it doesn't matter. If you're wrong, you're wrong. And one of the comments he said was, every day I assume that every position I have is wrong. So he's got a very high filter process to allow those trades to stay in his portfolio, which is why he stays in the game so long. He's only staying with the very best stuff. And if he's wrong, he doesn't have his ego in play. He's not saying, you know what, I should be right. He's banging his fist on the desk. He's out of it. All he cares about is the money, the bottom line at the end of the year, end of the quarter, whatever he's measuring it on. Okay, number 3, guys, learning from failure. So this is a good one. He says, failure was a key element to my life's journey. So obviously he's talking about life here as well, but he would have brought that into his trading career. It's such a key point to make, you know, and I've mentioned this before, guys, when we've talked about kind of analysing our own trades, seeing what went wrong, seeing what we can do better. You know, very often we gloss over it. We have a kind of period of failure, or we don't do very well, and we kind of brush it aside and move on. You know, learning from that. Why are we over trading? Why are we not making money? Why are we doing this? Why are we doing that? All those things that we're trying to overcome as traders and be better at. You know, learning from it is the key to improving, rather than just saying this is a problem, I know it's a problem, blah, blah, blah. You know, adjusting and adapting, and a really good lesson that we can take on board. All right, guys, number 4, never added to a loser. There's a famous picture he's got up in one of his videos in the back of his office. It says losers add to losers, or something around that kind of phraseology. But he basically doesn't add to losers. If a trade's going against him, he's not going to keep adding to it, hoping it goes back. And it sort of ties in with that lack of ego also that he's got there. He's not believing that he's right. If the market's not telling him he's right, he's not going to stick in it. Now, does he probably scale in within a sort of chunk of area? We don't want to take that too extreme and say, okay, well, does he ever add to a loser? I'm sure he scales in over a kind of price level that he's prepared to get into. But the point is, he's not adding again, reassessing the thing and saying, oh, you know, I'm down X% on that, I'm going to add some more. You know, he never ever does that. So it's quite a good, simple rule to do. Don't ever add to the loser, because if you're wrong, then, you know, the chance of you being right, okay, it might come back and you've kind of lowered your average price. Fair enough. And there are some strategies where that works well if you're investing or longer term kind of approach perhaps. But for trading, you know, if your thesis is wrong, your thesis is wrong, and you've been proved wrong in the market. All right, guys, number 5, risk manager first, trader second. So, you know, he said that at the end of the day, the most important thing is how good you are at risk control. It's so true. There's no point in being a great trader and then losing all your money on 2 trades that you're losing, because mathematically, however good your strategy is, and this is 100%, which no one does have, you are going to have some losers in there. So if your risk control is poor, you could be absolutely the very best trader with a massive high hit rate. But if you start putting your chips in too much too soon on too many trades, you're out of the game. And it's just a pure statistical fact. So risk manager first, trader second. Great thing for you and I to take on board. Where's the risk in the trade? Where's the risk in this trade? Whether trading off a 5-minute chart currencies, whether trading a longer daily chart on stocks or indices or commodities, whatever. Where's the risk? Where's the risk? Where's the risk? Where's the risk? How do I manage it? What's my position size going to be? All that needs to be defined before we start going into the details of what the chart's telling us, where our target's going to be, etc., etc. All right, number 6, cut losses quickly. So similar theme here about the losers. Where is his comment? Here we go. If I have positions going against me, I get right out. If they're going for me, I keep them. Risk control is the most important thing in trading. If you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. Great advice. And I've heard this as well from another trading firm when I visited the head trader many years ago. Oh, the owner actually. And he said, do you know what? If someone's uncomfortable with a position, just say, just halve it and see how you feel then. If you're still uncomfortable, halve it again. Do not overthink this. If a position is uncomfortable for you, you need to reduce it and trust your instinct. And if it's because you're trying to build your position size, that will grow, you know, i.e. you've got a bigger position, you're getting more comfortable with that, you need to still back it off. Because we've talked about this before, if you're going into a different side of the brain where you're making those trading decisions, it's going to be a different decision you make. So if you're uncomfortable, back off. Do not hold the loser, cut losers quickly. If it's going against you, get out. If it's going for you, you keep it. Same with, you know, some of the other traders. Talked about Jesse Livermore, talked about, you know, other greats. The same thing applies. And this is not new stuff, is it, guys? It's the same old stuff that everybody says, but it's putting it into practice. It's making sure you're not adding to the losers, making sure that you're cutting the losers. Those are the ones that do the damage. The winners, it sounds simple enough, but they're the ones that are going to make you the money. All right, number 7, reduce position size during losing streaks. Where was his comment here? Okay, when I'm trading poorly, I keep reducing my position size. That way, I will be trading my smallest position size when my trading is worst. This is a great lesson, and it's something that I take on board and I do, and it works very well. If you are trading good, you increase position size, you push, it's working for you. Your system, your strategy is working with the market. You get aggressive, you take on more risk, you try and build that account size. If it's not working for you, you don't get aggressive. Too many people do the opposite. When it's not working for them, they're getting more aggressive to try and get back to where they were. You need to flip it on its head and say, you know what, cut the position size, cut. Reduce that damage. You know, if you're in damage mode, reduce the damage. Yes, the thought with a lot of beginners and a lot of traders is, hey, you know what, if I increase my position size on this losing streak, I can get back to where I was a lot quicker. And of course, the logic makes sense, doesn't it? Oh, if I double my position size and get back to where I was and undo all the mistakes I made. Yes, but you're not thinking of the flip side of that, of the increased damage that you can do if you're not in tune with the market. Look at what you're doing, look at what you're achieving, look at how it's working for you, and if it's not working for you, dial it back. There's no need to take on excessive risk when you're not in tune with the market conditions. Okay guys, number 8, the final one, he only takes, or should I say, or I only take, I'm talking on Paul Tudor Jones, takes high risk reward plays. Okay. This is well worth listening to. This doesn't necessarily apply to everybody. There are traders out there who take higher probability plays but less risk reward, but this is something that perhaps you could take on board yourself. I look for opportunities with tremendously skewed risk reward opportunities. Don't ever let them get into your pocket. That means there's no reason to leverage substantially. There's no reason to take substantial amounts of financial risk ever, because you should always be able to find something where you can skew the reward risk relationship so greatly in your favor. You can take a variety of small investments with great reward risk opportunities that should give you minimum drawdown pain and a maximum upside opportunities. So basically he is saying, you know what, I don't look for 2 to 1s, I don't look for these 1.5 to 1s. I look for the trades where I can risk 1, make 10, make 20, whatever it may be, and don't have to take on massive amounts of size risk to make the money, because the risk reward ratio takes care of that for me. I don't have that risk of ruin where I'm going all in on something where it's only going to make me 2 to 1. I look for the big plays. And you know, you're probably sitting here watching this or standing here watching this going, hey, you know what, does that apply to me? Yes, it does. Even if you're trading currencies, whatever, look for the plays that historically could work out for you, could move 10 times your risk. So, you know, whatever you're buying a low after a multiple down move, it's kind of found a little bit of a base, and you've looked historically and said, well, if this bounces now, we could get kind of 3 or 4 day move, 400 pip move. You know, I can risk 20, 30 pips on this. It's a play that potentially could work for me. For looking for those, as opposed to kind of these kind of small little trades in and out and out. Not saying that doesn't work for you, but that worked for Paul Tudor Jones. It works for a lot of other people. It might be something to consider adjusting your trading strategy to suit that higher risk reward filtering process. All right, guys, those were 8 reasons that Paul Tudor Jones is one of the greatest traders alive. Hope you enjoyed them. Thumbs up if you did. Comments in the comment section below. Don't forget to subscribe if you haven't yet already. You like videos like this, I want to see more from me and other traders on this channel. Take care. See you soon. Keep the risk managed. Goodbye.